Tommy in Conway, age 52. I have a 401 from a previous employer. I've been away from that employer about a year and a half at this point. I've just been looking at different things, a little bit nervous about the market right now, and been looking at some index annuities. I'm sure you're familiar with them. It doesn't give all the potential, but there's no risk, supposedly. So just kind of looking for do's and don'ts on that, maybe diversifying. What are other options that could be on the safer side at this point?
All right, Tommy, thanks very much for that question. Great question. He tells us he's 52, so that tells us we don't know when you're planning to retire, Tommy, but we do know it's closer than it was yesterday, right? So we're getting into that pre-retirement stage. It's perfectly normal to be nervous about the market. It's perfectly normal to want to go to safety. I think as we discuss the index annuity and investment options, we should start with our disclaimer. We are not here offering specific investment recommendations on the show. We have to know you. We have to know your story and your plan and what's suitable to you before we can even begin to make an investment recommendation. So, Tom, if you want to have a real in-depth discussion, I would suggest you reach out on the hotline to call and schedule an appointment with an advisor. We have a Conway office right there for you, and you can call toll-free 866-653-PLAN to set that up, 866-653-7526. But we can generally talk about the do's and don'ts, as he mentions, about the indexed annuities. So let's start, Janet, with what an indexed annuity is.
Yeah, so let's start with what an index is, actually, because I think a lot of people don't even necessarily understand that. I was talking with another advisor recently. He and I go to the same church, and we were talking about the S&P 500, and he said, we really probably ought to call it the S&P 7 with 493 others, because people don't really understand how that works. So the S&P 500 as one of the indexes that is out there, the S&P 500 is the 500 largest companies in the country, and what we're talking about there is their capitalization. So those 500 companies, when we talk about the S&P 500 being up or down, it's based on what those 500 companies are doing. It doesn't have anything to do with any other companies. And frankly, Scott, it is very weighted, and so really there's a lot of movement with, I'll just say the top 10. We'll round it off there with the top 10 companies, and the other 490 don't have a whole lot to do with even the movement of the S&P. So it's not as diversified these days as a lot of people would think that it probably is. So when you're talking about the movement of the index, and people say the index, but many times they're talking about the S&P 500, but there are other ones as well.
Yeah, in fact, a lot of times the S&P 500 is referred to as the market. We've done this on this show when we talk about charts and history and all of that, because it's a measurement. But that's all it is it's a measurement. It's really never meant to be a benchmark to weigh your performance individually against. But as we talk about the annuity portion of that, what an index annuity really is, it's an account. It's a product, but it's an account that the insurance company offers to credit you based on the performance of that chosen index. So in essence, you're not investing any money actually into the stock market. You are leaving your money with the insurance company, and they are promising you to credit your account based on the performance of the index. And in most index annuities, if the index loses money over time, it protects against any loss.
And it's going to be a set period of time,
right,
like 6 years or something like that.
Yeah, a term will be on that product for sure. If the index gains money over that time, you will be credited a portion of that. It's often a participation rate, or it has a cap, one or the other. There's a limit on the upside, as Tommy already knew in his question, as he mentioned there. So you can get gains, you can protect against loss, and for someone who is fearful of the market, it might be an option as a component to your overall financial plan. There are also new generation annuities that have been out for about 3 or 4 years now that compress that a little bit. They're going to uncap the upside, but they're not going to give you 100% downside protection. So that changes the game a little bit too. You have the opportunity for more upside if you're willing to take on some of the risk by yourself, and that might come in the form of a 10 or a 20% downside buffer. So you don't get 100% protection against loss, but over the term, let's say 6 years, if the market is not down more than 20%, you would limit all of your loss. But if it's down more than 20%, you would incur some loss. So there's a lot of different ways that can get looked at. But I think the thing you have to know about with all annuities is first the surrender period. Because if you do go into an annuity, it is not really a liquid investment because you can get it out, but during the surrender period, you would be penalized if you did.
And it's fairly common to have a 10% free withdrawal amount so that you can access that percentage of the account without having any penalty. But if you needed access to more than that, you really want to know before you go into this that you have other dollars set aside that you could access in the event that you need to use them so that you can leave this alone during the period that the term is already set for.
Yeah, and so for that surrender period, for that reason, we would never put all of someone's dollars into an annuity because you have to have liquidity. Tommy, you may not need it in the next 10 years, but something could happen. You may have an emergency, so you would want to keep liquidity involved in your overall plan as well. So you wouldn't want all the money in the annuity. The annuity might be a place for some of your money, but he does mention maybe diversify. And I think that's the key here. Do we want you to diversify? Absolutely. You may be nervous about the market. I think that's perfectly understandable. But I would encourage you to think, are you nervous about the market right now? And are you nervous about the market over the next 10 or 15 years? Because there's a difference, right? I think it's perfectly understandable to be nervous about what's going to happen over the next 3 months, although as we just mentioned, the inflation data came in pretty nice. The market is surging. There's a lot of economic data suggesting we really maybe shouldn't be nervous, but there's a lot of talk out there. We've been talking about a year and a half about people talking about the potential of recession. You've got unrest in the Middle East. I mean, there's always an uncertainty around the right now in the market. But I think the point we're trying to make here, Janet, is if you, especially as you enter retirement or even your pre-retirement years, think of your equities still as long-term investments and not an account value number that when it goes down, you feel like you've lost everything. It makes a difference.
Scott, I think you make a very valid point about, Tommy, the question about what are you nervous about? Is it the right now or is it the longer term? And Scott, I'll tell on both of us on our ages, we're right around the same age as Tommy is here. And you and I have seen posters through our careers as advisors where they show back past the time that you or Tommy or I, any of us were born, back past that time for decades, they show these posters that will show the crisis du jour, as I like to call them, whatever the crisis of the day was. There was always something that would cause people to be panicked about the market. And so I do think it's important to go, okay, yes, right now, as an example, there's a war in Israel. Yes, that is a concern and we need to pay attention to it. But when has there ever been a time when there wasn't a crisis? And I think it's important to get to a point where you determine that you're going to invest for the long haul, and that may include some indexed annuities. We're not saying that this is a bad play at all. You may need a portion of that to protect some of the assets. It might be a really good play for you, but it's important to get past that fear as a motivator for your decision, because anytime, Scott, that we make an emotional financial decision, it rarely also happens to be a wise one. You know?
I agree with that. And I think the antidote to that emotion, taking that off the table, is a written retirement income plan. And that's what we do every day here for our clients at Gen Wealth Financial Advisors, because we're talking about investments. But Janet, really, your retirement is more than just investments.
That sounds like a good book title.
It sure does. I think it is just ingrained in my head.
Tommy, when we were talking through the question that you had, this is really something that kind of hit us. We John, my business partner, and I wrote a book a few years ago about your retirement needing to be more than just investments. And there's a lot of other things like more dependable, more independent. There's a lot of other factors that your retirement should be more. But one of the keys is that it is more than just investments. And your question, understandably so, is very directed at the investment side of it. And it's very important part of your retirement, but we have to be able to look at your investments as part of your overall plan, and that looks at things like how much income are you going to want and need, when do you want and need that income, is that going to change over the years? There's so many variables that come into play that help determine your investment, so it's really more of a conversation about you first and investments next.
Yeah, the diversification issue is huge, and I would encourage Tommy to certainly diversify, but how you diversify from our perspective depends on what your plan looks like. The investment strategy is going to be diversified, but in terms of percentages, how much goes here, how much goes there, it's going to be determined by a very definitive retirement income plan that has you in conservative investments that are liquid, that you're using today, but in more growth-oriented investments that you are not going to use for 10 to 15 years.
Hey, Tommy, we've got some good news for you.
Yeah.
You have the question of the week this week, and not only are you going to get one of these lovely little tumblers, if you're looking online, you can see Scott holding this up, but also we're going to include your Retirement Should Be More book. When we send you the tumbler, you'll get that book as well, because I think it'll just be a good little read for you.
Yeah. One other comment to put a bow on this conversation. Tommy mentions he has a 401k from a previous employer. I'm not sure if that's still in the 401k from the previous employer, since he's talking about potentially looking at indexed annuities, which is not likely going to be available inside of that former employer plan. But if Tommy does still have that in the 401k and he's no longer with the employer, or if you're listening and you've got a former employer 401k that's just been sitting there, we call them orphaned 401ks. We do want to give you the 4 options that are available to you and to anyone who leaves a job and has 401k dollars left behind. You have the opportunity, in most cases, if the new employer will accept a rollover, you can roll the 401k into your new 401k and just keep everything there with your new employer. You can leave it in that old 401k. There's nothing says, well, there are instances, I should say, where after a certain time the old employer wants you to take it out. But in many cases, you can leave it there for a pretty long period of time. We've seen that with our clients. You can roll it to an IRA, which would take it away from the 401k and bring it to an IRA. It is a non-taxable event to do that. And then you do open up the options that Tommy is considering, like indexed annuities and other things, either self-directed or through the help of a financial advisor and building a plan. Or you can cash it out. That's the last option, and we saved that one for last on purpose because it's the worst option. There's almost no reason we would ever advise a client to cash out their 401k, because guess what? You're going to be taxed on it. All of it's going to be taxed at ordinary income tax rates. And in Tommy's case, he's 52, so he hasn't reached the golden age of 59 and a half yet either, which means he's going to have a 10% penalty tacked on to that withdrawal. So you're going to pay north of 30%, maybe even higher depending on his income tax bracket, to get that money out, and we wouldn't want that to happen unless you're in dire straits and have no other place to turn. And so those are the 4 options. I would consult with a financial advisor. We help people all the time work through those decisions. An advisor can do that for you.